The following is a presentation of TFNN. It is now time for the Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi everyone, Basil Chapman on this first trading day of February. It is February the 2nd, and my pleasure to be here Monday through Friday on market days. Just a fascinating time, fascinating period in the market, fascinating period in history, fascinating period in football. That was even for a novice like me watching the game. It was very exciting, and things happen. And when you have the momentum, things happen to the positive side. That's just the way it is, I guess. So let's look at the market. Dow's up 12 at 17,178. S&P's up 4 at 1999. The comp index is now down 5 at 40, is that a 6? Yep, 4630. You've got, and this is going to be really interesting, you've got the E-mini right now having tested above the 1970.25 low of the 16th. It's almost like the sequence of arch-shaped patterns, and today's low so far is 1973.75. So less than 2 points above. But it did not go down to the 1960 200-period exponential moving average. The weekly chart is still holding quite nicely, and the 120-minute chart looks like it's just made a trough, a recycled A, B, C, D, E, a trough E, and we've had tons of failures. And at this particular point, two things have happened. One is on Friday, I had a very high reading in the what I call the Chapman Wave Trend Gauge. It's really Richard Arm's short-term trading index. Let me just show you right here. I show my subscribers to my opening call every day. This quintile with the left side 120-minute Dow chart, which made a peak D, plummeted down to a trough D at another arch formation, went to an E this morning. Now trying to rally off the low that was made, and that's really important. I'm going to talk about that in a moment. This is the VIX index. You know, I introduced the VIX here, 10 years or more ago to many people who had never even heard of the VIX, but I've considered it a very important tool in my arsenal of weapons to be able to integrate my technical tools as well as standard ones that are used into and market analysis. It's as simple as that. Well, we've gone to a leg D, almost a peak D at 23.45. You made peak E back around about the 16th of January. Then the VIX index, the volatility, which I just, to make it real simple, I consider it buying pressure and selling pressure. There are a whole bunch of things that you can read about it. That's fine. It's really important. I just make it easy for myself. I call it buying pressure and selling pressure. Right now, we're looking at selling pressure after having seen buying pressure. That is in the VIX. It's the exact opposite. It's the same corollary, same relationship with bonds rallying and yields falling, or bonds falling and yields rallying. In this case, when the VIX goes higher, invariably you will find the market goes lower, and when the VIX has selling pressure on it, it is buying pressure in the general market. So that gives us time. Most of the time at peak D or E in the VIX index, you get a pretty decent bounce, a really good rally. I'm going to say this rally goes into Tuesday or so. A couple of things I'm going to talk about. In the Trend Index, Richard Arm's, I have nothing to do with Richard Arm's short-term trading index other than their numbers. And if numbers get to a certain point, I look at them and I have reasoning over the years to have made two statements. When it's underneath and very low, then the very next day there should be a slide. When it is very high, the VIX, the trend is very high, invariably within 2 sessions, you'll come off a low. It doesn't mean to say that you're going to the very next day just have a big rally. It says that within 2 days, out of the blue, suddenly the futures, the E-mini, the S&P E-mini futures are going to rally. And that rally should translate into the cash rally. In other words, it could happen pre-market. By the time the general market starts, sometimes you've worn off most of the energy to the upside because you've been going down so strongly. That's what happened this morning. And then what happened, there was that 7 to 9 point rally in the VIX, in the E-minis. And then the market plunged to about minus 100 in the Dow very sharply. And then it came running back. We're now up 30 points in the Dow, up 6.5 points in the S&P. So that's what I wanted to show you. And right here is the bar chart of the Dow and the bar chart of the S&P. So the S&P broke its support, and the S&P and the Dow also just broke its support. So this is very interesting because the pattern that I'm looking at here is summed up really simply. Look at that. You see the mirror image? It looks like one of those prehistoric fishes that you see, right? A little, or maybe a piranha or something. Anyway, this is the mirror image. Here you've got the SPY, the trading vehicle, the S&P SPY, the trading vehicle for the S&P. Call it the long side. And here you've got the short side, the SH, 100% short. So you can see there's a mirror image. And that mirror image says, right about here, we're starting to get to a point of support. Right there, see, there's a point of support. So you could get another bounce. But if you start to break it, that mirror image says we'll go somewhere into there, somewhere into there. Okay, just make things real easy. There's just nothing complicated here. Unfortunately, it can become complicated when you add a weekly chart that says theoretically in the Chapman wave you should go to a D, and you're stuck at a C, and it starts to influence you because you tend to think of the larger tide, and that was wrong. I should have been thinking smaller tide. Very obvious. You've got an arch formation. You've now had 33 sessions to form the left side from there, October the 30th, to there, the low of December the 16th. And now you've got 30, this is the 31st session. And we just took out 17,067, which was my downside target. So you've got an arch formation. You've got key support right there. We went under it. We've bounced nicely above it. You know my rule in the Chapman wave methodology, an arch formation. When the left side low bar gets taken out, you have that bar or maximum one more to get right back to the left side low bar. In this case, you were underneath it. You had this bar, or maybe tomorrow, to get back above 17,067 in the Dow. The low of the 16th of December. So far, it's acted very well. And this is something that I showed my subscribers over the weekend. I sent out all my Monday charts. I started sending them out Saturday. Some of them I sent last night. And look, what you've got is time. You know, everyone, not everyone, but a lot of people talk about when the market plunges, it can very often take out 3, 6, 12 bars to the left side, and that's absolutely true. There's just no question about it. Look at this ugly bar right there. Look, that took out 1, 2, 3, 4, 5, 7, 8, 9, 10, about 10 bars, right? But my contention is that unless you're in a bear market, or if you're in a bull market, the time that it takes to get to the upside is invariably the same time as it takes you to get to the downside. Only in the bear phase, where you get that big acceleration down, do you get it. Well, so far we haven't had that big acceleration down below support. And that makes this test today of the 200 period move, this is the 200 period moving average right there, really important. We touched it. It's at 17,055. We went down to 17,037. So we've gone a tad under it. So you can see how I like to use time. I like to use price. I also like to discuss time and price in the sense that sometimes you'll get one and not the other. And other times, you will get them both as time and price just smash to the downside or rocket to the upside like it did here. Look, that was a rocket ship move to the upside. That was a rocket ship move to the upside. That was nothing right there. Look, little tiny baby doji candles doing nothing, making the body of the Chapman Wave Stork Leg Formation. Let's get to the numbers now that I've missed. So this is the first key support, but we are making lower lows and lower highs, making it as simple as that, which says it's a bear phase in the daily chart until things change, until we get a buy signal. So now what I want you to show you is gold, GC. Gold is, there's this tremendous resistance line right there. And until gold is able to smash into the 1290 to 1310 area, and take out the previous high of 1309, I suspect that we're just having a high-level consolidation. Is had a spectacular move. The weekly chart says, "Hey, I just need a little bit of rest. Do you mind? I've just been on a tear. I need a break," and that's what's happening. Key support is at 1253, the 200-period exponential moving average, and a breakout is about 20 points higher. 20 points higher, meaning 1292-ish area. Silver also up. Silver's up nicely. Silver is at, let me just double check here. So gold is down 6 at 1272. Silver is at, if I can just find it, 1724, up about 3 cents. Platinum is down. Let me just look at Plat. PL. There it is. Oh, made a peak E in the daily. It's in a sell mode right now, shorter term. And the weekly, see, this is the thing that I'm looking at. And I'm looking askance at all the commodities here. And I'm saying, gosh, they've just been hammered and hammered and hammered. Platinum is sitting right on the 200-period exponential moving average. Hasn't been able to hold strength at all. Well, I contend that gold is the same thing, that gold is having a really good move right now, but it's only part of a larger bearish situation. I might be completely wrong. We are in my opening call. We are long gold, but I'm looking at it and I'm saying, that pattern I've seen many times before. I think you're going to come back and retest the lows. And in this case, it would be the low of 1132, the low that was made back in November of last year. We'll see. And it doesn't mean to say you can't go higher. I'm looking at the upside as a potential to the 1351 to the maybe even 1397 area. Just another big arch formation. Okay, I got a couple of questions, so let me get to this. EUR USD is the euro-dollar currency pair. Stuck. You see what I mean about these patterns? These H patterns are deadly. They just don't allow you to break to the upside unless you make that V pattern. And the USD JPY, oh, I promised I would get to the crude oil and natural gas. I will still get to that. I'll be back, and we got questions in the net. I'll be back. Basil Chapman, Dow's up 16.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you, like it does me, call 1-855-750-4051 to find out what they can do for you. That's 1-855-750-4051. Call them today. Everbank is a member FDIC and equal housing lender.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman wave sequence. Using the Chapman wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Check out the new look of Tiger TV. Now you can see all hosts, charts, and computer screens live in high definition. Whether it's Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, David White, Larry Pezzamento, Andy Hecht, Thinkorswim, or Carol Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV. Now, crystal clear in high definition, 24 hours a day, 7 days a week. If you haven't seen the new look of Tiger TV, then visit TFNN.com. Basil takes your phone calls. Now, toll free at 1-877-927-6648. Internationally at 727-445-1044.
All right, quick question about FANG, F-A-N-G. Let me just do that. FANG, don't type too quickly. Is making a leg E in the daily, a real stair-step move, like a V-shaped pattern, very steady. It's holding very well. Diamondback Energy Inc. And I suspect that what we're looking at here is going to go into a trading range in this leg E between somewhere 67.80, maybe even between 67 and 65 as the lows. And at some point, it's going to try to have a bounce and get to 72.94, the 200 period smooth moving average. I think it's then going to fail. In other words, it's making a counter trend move. And the big test will be, how does it hold 65 to 63 support in February? Not so much how does it bounce, it's how does it hold a rally without breaking down. That's the big question. Based on the monthly, which has had an outstanding move going to a peak since the IPO, all the way up in the 93.33 area, plunges down to 50, what was that, low of 51, 64, 69. So now it's had about a 40%, 37% rally. It could have a little bit more, and then I think it takes a breather. So that was that. Disney, where to short Disney? Disney is a Diz. I think Disney has earnings coming out this week. I've always been a little confused. I've never taken the time. I always think of Disney as entertainment with all their parks, theme parks, but they have so much stuff going on that it is a mighty, mighty, mighty a company, and they're able to weather a lot of disturbances. Now, this should have been not a B but an E, a peak E, alternate count, top right in that candle there. I saw it and I forgot to change it recently. And that was the spike to 96.43. My suspicion, based on what I'm looking at, since we're in a bearish phase in the daily chart of the S&P and the Dow, and I'm waiting, probably midweek, I'm going to be able to give a better decision on what I'm looking at in the weekly chart. My suspicion is that Disney could even have another little bounce. It's at 90. It could go to 92.87. But as I'm looking at it, the 87s would be the downside target. Another 3 points down is in this phase, in this negative phase that I'm looking at right now. How long does it last? I had said that we've got a left side, right side price time match to February the 4th. Well, on the 2nd, that's today, it took out that low bar. So let's watch this real closely. But it is making lower lows and lower highs. That's the theme of this particular phase. If the Dow can get to 17,000, and Disney's part of the Dow, 17,460s by 17,460s by I would say Wednesday afternoon, Thursday morning, I'd start to be impressed again. At this particular point, I'm waiting to see how it forms and how it resolves this whole left side, right side platform, horizontal platform in the 17,000 area. Start to trade in the 16,900s. It's not good. I think there's a bit of a bounce coming here based on my Chapman wave trend gauge. There was a question. Okay, natural gas. You know, in this kind of weather, if you're not getting, for the last 3 weeks, 4 weeks, 5 weeks, if you're not getting natural gas, instead of being at 2.616, it should be at it shouldn't even be at 3.1. It should be above the high that was made on the 15th of January, excuse me, of 3.3, what was that, 3.321. So it's just telling us that there is way too much supply, and that if you're going to play natural gas, you can play it any way you want. There was a question of, I lost it. Was it UGO? UGO? Nah, it wasn't UGA. UGA. Is that right? Whoa, what is UGA? United States Gasoline Fund. Wait a minute. Oh, that's oil. The gas is doing. I was going to go to gas next. So in other words, natural gas, I don't see anything other than a real short-term play. A trade, a play. It's not a position. It's just something, a swing trade type thing. It could even go longer once it turns around, but it's really not looking good. Now, the next question was UGA. That's why I remember the name. United States Gasoline Fund LP. And I'm sorry I didn't get back over the weekend. I spent a lot of time on this. I was so busy looking at the charts. I didn't want to be distracted by moving away from too many different things. But the USO, which is the United States, what is the exact title? United States Oil Fund LP, and UGA is United States Gasoline Fund LP. What is the difference? Is one 200% or something? I don't know what the different chart. Oh, forward month, backward month. Oh, I should ask Andy Hecht. I'll be back and we'll talk about this. Dow's up 46, S&P's up 8. Be right back.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. Trade with confidence and clarity while using the software that thousands of institutional traders rely on to make the best and most accurate decisions. Choose from 1,000 equities, currencies, and futures instruments utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. John Logan hosted a special subscriber-only webinar in December, and you'll gain access to that archive as well, so you can learn exactly what the TAS Profile Scanner can do for you. Try this product out. No matter what you trade, the TAS Profile Scanner can help you make more informed trading decisions. There's no obligation to pay anything. Don't let this offer pass you by. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
You know what's cool? Taking something that's good for you. Something specifically formulated to help with weight loss, better sleep, stress reduction, and the need to detox.
Nico, our hunter and gatherer ancestors found all their nutritional requirements for health in their wild environment. But today, our food sources no longer contain the vitamins, minerals, and nutrients our bodies need to stay healthy and strong.
That's why we need Primal Edge Daily Nutrition. It includes a special blend of ionic, soil-based vitamins, minerals, fatty, and amino acids in an easy-to-use liquid form.
Primal Edge is powered by highly concentrated fulvic and humic acids, nature's preferred delivery system. They have been called miracle molecules because, like sunlight, air, and water, life cannot exist without them.
That's right, Paige. They ensure we receive all the nutrition we need to be healthy and thrive. We take it every morning.
Primal Edge, formulated and approved by Nico and Paige of Living a Primal Lifestyle. Buy it today for just $89. Click on the Primal Edge banner on the front page of TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks, we're back. So the UGA made a peak D at 65.86 back in February of 2013. Made a little cup formation, didn't get back to that high, then it failed, right shoulder failure, plunges down and goes from the 60s to the 29 something just a couple of weeks ago to 28.60. Trading now at 34.50. That is a great. That's $6. I mean, that's a big percentage gain, right? You've got a 18-20% gain, but it's coming from that much lower base level. So now it's stopping at the 9-period exponential moving average. Now the question I had is, I want this for a 3 to 6 months position. I'm not interested in anything less. So UGA is gas. Okay. This is gas. So this is USA's gas, and it's not natural gas. What is it? It's gas. And USO is oil. All right, I've got it. Because you've got UNG would be natural gas, which still looks terrible. So UGA is acting very well. On a daily, much better than the USO on a daily. And the USO bounced strongly on Friday, bounced this morning, pulled back, and then continued higher this morning. So I thought about this a lot, and I'll both send a note, but I'm also going to mention it here. If you're looking 3 to 6 months, I don't think that that's the position. However, if you're looking at a percentage gain, if you go, let's at 1828, if you go from the 1828 to just a normal bounce of 35 to 50%, that is from the low, would take you around about 25 to 28. Well, I would consider that anytime, even if it was 2 weeks, I'd consider that a longer term trade because of the percentage gain. But my suspicion is that there's going to be a little bit of a pullback. That's number one. And that the real gain will be you're able to be able to judge the upside by the price point that is able to support. In other words, if at 18.28 USO it pulls back to the 1750s or higher, and then starts leg B and takes out 1890, that's very good. Excuse me. That says 1999 is the 9-period exponential moving average in the weekly. When you look at UGA, it is closer to the 9-period exponential moving average. And if it only goes from 34 to the 43, 45 level in a bounce that doesn't even take it close to the 200-period moving average of 52, that's very nice. So let me just put it as succinctly as I can. I would start a small position now because we've missed the best opportunity in UGA. It should have been probably Friday would have been a good point to just at least start it. But having missed that, it's at 34, 3 points higher, 10% higher. So I would like closer to the 3210 to the 3150 area to start the actual position. And even then, I wouldn't get a full position just yet. I'd just start the second part, nibble here, and then wait and wait, have patience for a pullback. And then what I'd be looking at are numbers rather than dates. So I'm answering the question, and I'm doing it in an obtuse way, in the sense that I'm not saying to you 3 to 6 months. I think you'd be very happy if you got yourself a 12 to 15% gain or higher in that kind of time period. So if it's a shorter period, that's even better. Then you take your money and you run. You say, hey, that's it. So I'm talking about the percentage rather than the time. And I think that percentage more than makes up for the time because you've got free cash again once you could get out of it. Even if it goes high, it doesn't matter. It's achieved your purpose. So what would I look at? It's fill the gap. UGAs fill the gap from the 32.94 low of the 2nd of January to the high of 32.24. And now what we're looking at is that'll be the area, somewhere into the 32.5-ish, maybe 31.80, somewhere in this area right here is where I would consider starting the real position. So I nibble even here at 34.43 because it looks like it wants to go higher, even if it pulls back. And you're talking about 3 months or so. I'd use that the time I'd use for the pullback now, because on a percentage basis, once again, 34.43 down to 31.20, 2.5 points. That's kind of a big percentage. So you're only starting a little position. The better part of the position gets put on right there, and hopefully it'll be by Thursday, Friday, or Monday of next week, and that's in the 32.20 to 31.90 area, or maybe even 32.45. And once again, you spoke about a stop of 8 to 10%. That's the stop is going to be based on this position here, not that the very first one that you start right here, because it's only a small little position. It's a kind of a feeler pilot-like position. And then what I would say to you is, if it achieves, without being stopped out, if it gets to 36.71, 2.5 points higher, I'd raise my stop on part of that position. And I would just say, hey, you tell me, great, you've been beaten down like nothing on earth. Now you got a reflex rally. I don't expect to go that far, but it might give me the percentage. And then if it had to get anywhere to 39.41, a majority of my position would be out. And I have a stop on the rest and say, hey, take me wherever you want. Because at that point, I think you start to get the H pattern and oil starts to, or gas in this case, starts to come down. And in the oil's case, it comes down as well. So that's the only way I would do it. I can't say to you that I can see a 3 to 6 month rally from here. Not yet. I might see it later. But first, I want you to see those percentage moves off the bottom. Okay, so we've got that. I discussed the two major things that I wanted to talk about. And I'm going to just go to, I was asked about bonds. I haven't discussed bonds. We have gone to a leg E. There could have been a recycle. I think this is just normal. It's gone to an E. Well, I don't know if you can say normal when you talk about yields at all-time record lows. But I think this is an E. And I think that the TLT and bonds, let me show you something. This is F, unless it's recycled and it's a B. And you go 1 penny above 138.50, and I have to consider that's a new leg C. But everything about the daily, the weekly, and the monthly is saying, hey, I'm getting a little bit tired, and that corresponds to this chart right here. Oh, I forgot to show my subscribers. I'll do that tonight. Look how low yields went, and now we might be making a trough E in the weekly chart of the 30-year T bond yield. And that's very interesting because it's at the lowest lows it's ever been, but not the 10-year note. It's been here before. It was there back in April or so, April, May of 2013. And the 5-year note hasn't even taken out the 11.18 low. So I'm going to be watching to see, is there a cluster formation forming here? Are we about to start a bearish overlap of yields? We'll see. So, okay, now I wanted to show this chart here. Look at this. This is a chart. This is a rail right there. This is the SPY. This is a General Electric. This is the Dow Diamonds. This is the QQQ series, and this is the IWM, the Russell 2000. Look at these charts. So this one has not gone to a new all-time high, which would be above 123.61. Usually that's a negative. The SPY went to an all-time high, and now it's holding this very important trend line long-term, weekly. I mean, look how long this is. This is very long-term. The General Electric has been underneath and going sideways to down, and that's really not a good sign. The Dow Diamonds have not touched that line, and that's a positive. The QQQ series hasn't had as spectacular moves in terms of breakouts to the upside, but it's just steadily made higher highs until recently. And now it's just stuck in this range. Now we're watching this one carefully, but it's still way above that trend line, that rising trend line. Then you get to the IWM. The IWM is just struggling right now. It's stalling. It needs very much. If the IWM starts to trade at 108, and right now it's at 116, 108, anytime in February, that's going to be very negative. If it takes out the high of the week of the 30th of January, that was last week, and goes above 119.45, that's going to be really important. That's going to be very bullish. So I'm watching this setup right here because of all these different indicators. And you've got the metals right here. Look at this. Metals are saying gold, nice action, but all within the context of a lowercase h that goes to a lowercase m, just bounces. That's all they are so far. This one's the strongest, starting of February with a candle like that. Well, we have to wait for the end of the day. But in the meantime, this is going to be very important. And silver is acting okay. Not great. Gold is leading. Silver's following. Copper is the one that's really poor. Look how poorly it's acting. This is now a downtrend line. And that's a monthly chart. It's just not very good. It talks about the economy, really. And this is platinum. No, not bad. Looks a little bit like gold, but not great. And this is crude oil. Crude oil's broken down. So when you put these commodities, these particular commodities together, it's just a very interesting thing. They all have lousy charts, but some have a little bit better charts on the shorter term than the others. Okay, question the Den. IWM still monthly oval pattern. Yeah, isn't that interesting? Look at this. IWM. The Russell 2000 iShares. There's that pattern that I call the leg, the body, the Chapman wave stalk leg formation. It suggests that at some point unless this becomes an arch formation, which it isn't at this particular stage, because it is trading under 110, trading right now at 116.10, up 40 cents. So far, it's holding that 9-period moving average. If it was to break above 121.41, that starts leg D on the neck of this particular formation. So the parameters are really clear. 6 points up, 6 points down, big difference in the monthly chart of IWM. My big concern here, was that an alternate count in the weekly chart? Was that really an F and not a C? I don't know yet because it's just held so nicely. But I don't know, because that recycled to ABCD, so that's the low, and we've gone lower than that low. I don't know, this is one of those complicated things. I wish it wasn't so complicated. I do want to talk about a couple of things here that, to my eye, are very important. One of the reasons is I put a lot of emphasis in the weekly charts. I call it the sandwich. What happens is that when the daily chart really takes a dive, it impacts the weekly charts very often quite hard. The daily chart can actually make a really nice comeback while the technicals and the weekly are struggling. It's like a sandwich, and that middle part, the bologna, is just full of bologna. It takes a long time for it to heal. So far, the action in the IWM, even though we were looking at that monthly chart, which said that it's a little bit stuck, the IWM weekly has got a cup and a potential ladle. Remember, I spoke about this before. It was a ladle and cup, and now it's going to be a cup, a handle and cup, and now it's going to have another handle. And this handle is higher up. It's with better technicals than it was over there. It's really important. I got to keep watching these things. There are mixed signals here. So then I had a question. Would I look? Oh, here's a question as well. Apple monthly. Apple, very good. Apple. You've got Apple, leg D. I'm calling it alternate count change from the weekly chart to the latest leg D in Apple. Leg C, peak C actually in the daily, it should still go higher. And the monthly is in leg E. I'm calling it E. I said there's no reason to call it anything else but E at this particular point. So yes, and the technicals in the monthly are very, very strong still. The weekly is improving. Remember, that's the weekly got hurt when the daily took all that energy to the downside. Right there, it took time and price, going from 119 to 104. That's, 14% or so. And then you got a very nice bounce. Well, that bounce has improved the monthly, but it's improved the price of the weekly, but not the technicals. Technicals are stochastics at 66%, and the MACD hasn't crossed positive. So we're watching this real closely. Now, what I want you to say is, I've been speaking for about a week now about the IBB, that at some point we're going to get the rollover. Well, the IBB had a very sharp move to the downside, was down 4 or something like that earlier on. Now it's only down 88 cents. Money's still going to keep trying to come to the IBB. But at the same time, there are definitely signs that there are stocks within the biotech sector that are just very tight. They're still a great longer term. They just need a rest, and that rest could start to impact the weekly charts if they rest a little bit too long. So that's what we're going to be looking at. But if you put the XLV together with this, look, the XLV is the S&P Select Healthcare Spider Fund. It's just been amazing. Look at this. The 9-period moving average has been touched only once, but it hasn't even closed below it. I'll talk about this when we get back. The XLV is the S&P Select Healthcare Spider Fund. I'll be right back. I think it's topic.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at directionshares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Catch Larry Pesavento, a 40-year veteran trader. He uses pattern recognition, Gartley's, butterflies, ABCs, and Fibonacci in order to trade these markets. Trade what you see. Next on TFNN.
Folks, yes, listen to Larry. It should be a great show as always. Good programming all the way through today. And I just wanted to show you, so the XLV, that is the S&P Select Healthcare Spider Fund, has been in a beautiful up channel. It's also mostly walked the 9-period exponential moving average, but every once in a while it goes under the 9 EMA, and it doesn't do that for more than 2 bars, 2 weeks in this case, and then bounces right back. This is the test. If this week it closes underneath 69, let's call it 69, and next week it closes under, say, 67, there's a change of trend, and that trend line support is going to break. So I'm watching this real closely. I've got a rectangle formation. It says it could take a little more time just going sideways, not breaking out by more than a little bit, and then coming right back into the rectangle. Most probably, if the rectangle lower part gets tested, you've lowered the cap to the 9 EMA of 69. 69.30, I should put. So, and the monthly chart is not yet shown. Excuse me. The monthly chart, let me just have something to drink here. monthly chart has just shown no signs yet of price deterioration, but the stochastic has been coming down, and that's a tip-off to say be careful. So that's it. So let me just go through this again. The Dow has made that 34-month, let me just do this, INDU, 43-month left side, right side price match. And that says it's January because there was a lower high bar. Now we've got to be careful. All I can say is that 9-period moving average, I'm watching it closely. Doji candle for December, red candle for January, and now we're on the 9-period moving average. A close in February below 17,000 would be a tip-off to say, hey, watch out. You're gonna have another 6 weeks or 8 weeks maybe of weakness. And that's why we need to just go sideways to up from here. But I think that we've got to watch this real closely because here's the daily. Hit the 200-period moving average. Broke the 70,067 left side, right side price time match. There are a lot of things that are saying the 9-period moving average of 17,382 is going to become a resistance line. So you need to see the Dow by the latter stage of this week start to trade and close above 17,400 for us to say, hey, nice. You've just gone into that sideways trading range. It's like a rectangle in the lower part. Now you're going to work your way to the upper part. Lots going on, and I'm going to make it as simple as possible. The VIX index. A VIX trading right here, 2017, is kind of a negative. It puts a cap on the upside. A VIX trading in the 18s or lower starts to see buying pressure in the market, and a volatility index pushing back into the 21, 22 area says, watch out. I'm going to target that 2344 level for a peak, for a leg D. So we're watching this real closely. And other than that, the one thing I wanted to mention is that if the TLT does take a breather here and just starts to go sideways and treats 133 as support, it's 137.15. Sorry, I meant to say 135 to 133 as tremendous support. That's okay. Break under 133 in February, and all of a sudden what you might see is that yields start to climb, and we could even see how money starts to flow out of bonds and possibly back into equities. So there's this relationship, a very sensitive relationship going on all the time, and we're going to have to monitor it real closely. I believe I got to almost all the questions that I could see in the den. I hope I didn't. If not, just send me a couple of questions and I'll deal with it tomorrow. HEDJ. Oh, was that copper HEDJ? As we go out, HEDJ. Oh, I missed it. It's too late. I'll do that tomorrow. So I write it down. HEDJ.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TFNN.